so far? I mean, how do we know each other? Okay. Are you a Power Options subscriber? Is this your first radioactive trading webinar? Have you been to others? Let me know where you fall in the spectrum here. I think you can actually vote in more than one category. I could be wrong on that. If I am wrong on that, just vote in the most appropriate category. So, all right, very good. Yep. No, you can definitely, this adds up to more than 100%. So, so you can definitely vote in more than one category. Okay, so I'm going to leave that poll up for about another 5 seconds, and this is just a practice poll. The rest of them are going to be even shorter. Okay, so 3, 2, 1. Let me close it. Okay, so only 9% of you subscribe to Power Options, and I would like to fix that. I think that anybody that trades options should be using the Power Options platform. Now, I'm saying that not being a partner, or I mean not being an employee or whatever. I guess I'm kind of partnered with them, but I was a customer first. And so I'd like to give you a free 2-week subscription to Power Options for the 91% of you that are not. Okay, 70%. This is your first radioactive trading webinar. Welcome. We're very glad to have you, and I guarantee it, this is going to exceed your expectations. It's going to be a lot of fun. We're going to have a lot of back and forth, a lot of talking with you. When I say talking, I guess what I mean is it's going to be this text thing because it just doesn't do. We've got 197 people registered for today's webinar, and still more of you are spilling in right now. And it just doesn't do for the phone to ring or the doorbell to chime or your kids to ask you something or your grandkids or your wife or your husband while we're right in the middle of this, and everybody has to hear that. So I've got everybody muted. Okay, let's go ahead and get rolling here though. I'm going to start off with a pop quiz, which is always fun. Well, hey, you signed up for a class, right? So we're going to have a class, okay? So here's the pop quiz, all right? You're playing long call options, all right? You're playing long call options. Now, if you're not an options player, that's okay. But let's just say you're playing a game that has a chance here. You're able to get out with a 40% loss if your stock really goes against you in this leveraged play. Okay, you're able to get out with a 40% loss because this is a leveraged play using call options. Okay, but if you win, it'll be a 66% gain. Okay, so you've figured out your charting, you've figured out your picking, your stock picking, and your charting, your timing, your entries and your exits, and you know that if you win, it'll be a 66% gain. If you lose, it'll be a 40% loss. And you're wrong just a little more than half the time, say 55%. Okay, so I've got a question for you. Are you ready? Should you play the system? Should you play the system? Okay, I'm going to go over the numbers again real quick in the poll itself. Okay, let's see. 40% losses when you're wrong. All right, 40% losses when you're wrong. 66% gain when you're right, and you're wrong slightly more often than you're right. You're wrong slightly more often than you're right. Should you play this game? Should you play this game? Okay. Well, we've got representatives in all 3 categories. We've got folks in all 3 categories that are doing this, that are telling us what they think, and I appreciate that. All right, we're going to leave it up for about another 10 seconds or so. It's evenly split. Oh, for a second there it was 33, 33, 33. It was evenly split. Now the game has changed a little bit. All right, so that's about it, folks. I know that some of you haven't had a chance to vote yet, but I'm going to close it in 3, 2, 1, close. Okay, very, very good. All right, now I'm seeing questions come through. Lots of questions. We'll be able to get to them there, guys. I do promise that we will. Okay. All right. Very good. So let me go ahead and share this result. Okay. 26% of you that voted, almost all of you voted. Okay, but 26% of you said that a 66% gain offsets the 40% loss. So losing slightly more often is okay. All right. And then 33% of you said it's a trap. The 26% different is not enough. You know, even though you're making 26% more when you win, you're not winning. You're still not winning enough to make this a winning proposition. And then 41% say, I'm honestly not sure what to do. Was enough information given? Okay, now I'm going to go ahead and tell you that yes, enough information was given, although you may not have had enough time to process it. Okay, now here's what we're doing. I'm over here on radioactivetrading.com, and hopefully you can see the screen. Let me just check in with you. Please let me know. Letter Y or yes. Okay, let me know. No. Oh, okay, yes. All right, some folks are seeing it. Willie sees it. Cool. Who else is seeing it? Can y'all see the screen up there? Okay, good. Y. We got a lot of letter Y's going on. Oh, Albert says no. Steve says no. Okay. Folks, you might need to refresh. I will do what I can here to refresh. Let's see here. Just want to make sure that we've got the screen showing.
Kurt, can you hear me?
Polls hide and re-share. Okay, how about that, folks? Are we gooder? Is it working out? Yes. Okay, we got a whole pile of yeses and Y's. All right, I appreciate it. Okay, good. All right, thanks for that feedback. I need to know these things, okay? Because I'm flying solo right now. I was expecting to see Mike, but he's not here today. Okay. All right, so this is Kurt Frankenberg. All right, so here's the deal. We've got a target return of 66%, and then we've got a loss limit of 40%, and a probability of loss slightly more than half. Probability of loss is 55%. And we've got a starting amount of $100,000. Okay, pretty cool. And investing 100% of our pot per trade. And so in the simulation here, we start out with a whole pile of losses. Then we had a whole string of winners, then some more losses and wins. Okay, this is random, and it's random according to this 55% probability of a loss. Okay, and so we ended up with actually a little bit more losses. We got 51 losses. Oh, less losses than we expected. Okay, we got 51 losses, 49 wins. And not surprisingly, we took our $100,000, the capital that we started with, and turned it into $29,000. Not cool. Lost over 70%, and that doesn't even take into consideration commissions. You can do that, by the way. All right, let's run it again because you know, maybe this was a good idea. Maybe it was. So I just ran it again. Okay, this one we didn't actually get to the full 100 trades. We went bankrupt after 78 trades. Let me run it again. Okay. Well, this time we took $100,000 and turned it into $10,000. So not cool. All right, one more time. $100,000 and we turned it into $505. So I guess the answer to the question should be no. We should not play this game. If we found out a way to use our long calls and make 66% when we're right, but only lose 40% when we're wrong, but we're wrong slightly more often than we're right, we should not play this game, right? Well, let's take a look at something. You know what I'm going to do? I'm going to just simply do one tweak. I'm going to change the amount that we invest. Bam! 5% invested per trade instead of 100%. Now let's see if that changed anything. Look at this. Took $100,000 and turned it into $121,000. 21%. What do you call it? 21% return. Okay. I just hit it again. Okay. So here we are losing more often than we're winning. But because we're only betting 5% of the capital that we have in our pot, we take our $100,000 and we turn it into $134,000. Wow. Let's run it again. Isn't this something? Okay. Another 34% gain. And then finally, we doubled our money on this one. Okay. All right. Very cool. Well, folks, I've got a question for you. Okay. Whoops. I got a question for you. Did you see that one coming? First of all, that first little math problem, you're not really sure, right? I mean, if I gave you the correct equation, if I gave you the equation that deals with expectancy, then you'd know that this game was not a good one to play with all of your money. but it would be a good one to play with a little bit of your money at a time. So that's kind of exciting, isn't it? Okay. All right, folks, this is Kurt Frankenberg. I'm the fellow that's talking to you right now. It may say Mike Chupka on your screen, but that's because this is an account that I share with Mike for doing these presentations. All right, so this is Kurt Frankenberg. My good friend Mike may be joining us, and I hope that he does. Maybe you are here, and I'm just not. I'm just not hearing you, buddy. It's a possibility. Okay, so here's what's going to happen. Okay, first of all, I'm going to tell you that what I just showed you is fist. Okay, fist, and that means to force ideal sized trades. If you force yourself not to bet too much, to put too much of your capital at risk, there are some scenarios that will turn out better than you think. Okay, so we had a losing game that turned into a winning game just by changing one thing, and it wasn't how often we're right. It wasn't a new strategy for picking stocks or reading charts or anything like that. It was simply determining how much we were going to put at risk. And guys, this isn't what I came to teach you, but I'm going to tell you this. You could actually hang up the phone right now. You could actually quit this webinar and go and learn as much as you can about position sizing, and that will change your whole trading record. It'll change your whole trading world. All right. So I haven't even made my 3 promises or fulfilled them. So let me go ahead and make those promises here. Here's what you can expect today. We're going to have 3-way interaction, 3 promises that I will make good on. Who is speaking now, Clive? It's Kurt. This is Kurt Frankenberg. Okay, and you can expect a boatload of polls and participation because I really want to get to know you, and I really want to know who I'm serving and how I can serve you better. Okay, so today, making another set of 3 bold promises. 3 bold promises. Here it goes. Number 1, I'm going to show you how to protect your stock in case of a sudden downturn to under 5% risk. Now that sounds pretty good, but we're not going to use a fickle stop loss order. Okay, we're not going to use a stop loss order because a stop loss order does not protect you the way that we think it does. 2 things. Number 1, if you buy into a stock at $100 a share and you set your stop loss at 95, then there's a 5% stop loss there, right? Okay, well here's what's going to happen. Very likely your stock is going to dip down to 95 and then take off again. If your expectation was that it was going to go up and you were right in your expectation, well, it's going to probably not going to go up in a straight line. It's going to very likely dip down first or dip down at some point, and then you'll get stopped out at 95 and see your stock go on to 105, 110, 200, just without you. So not cool. The other thing that a stop loss can do to you is it can violate you by this. If your stock opens because of bad news, if it opens at $80 tomorrow, you're not getting out at 95. You're getting out at 80 because a stop loss order is nothing but a market order that activates the moment that that the stock violates the order. Okay. All right. So anyway, what I'm going to be sharing with you is absolute protection, not a fickle stop loss order. Number 2, I'm going to show you how to execute a bear call spread with 0 risk. And I know what some of you are saying. What? That's not possible. Well, yeah, it is. It's possible to do a bear call credit spread and do it completely risklessly. And I'll defend that here in just a few minutes, okay? By the time we're halfway through, you'll have seen it already. All right, and then finally, number 3, I'm going to show you how to bulletproof the stock that we talked about in promise number 1. Okay, so those are the 3 promises. At the end, I'll tell you how to get more of this kind of information if you want it. Okay, but today I'd like for you to sit back. I'm not trying to sell you anything at this time. At the end of the presentation, I'll give you links and access and so forth to further information if you want it. Okay, super. Well, here's the question. Can a spread trade be performed without risk? Now, before I answer that question, I'm going to find out how many of y'all that means something too. Okay, so I'm just going to ask you, what kinds of trading are you doing right now? All right, what kinds of trading are you doing right now? Are you doing no options yet, or are you new to options? Are you doing what I call the gateway drug, where most people start is with covered calls? They may graduate to naked puts, which is pretty much the same trade, only it's upside down. You collect money in the first place. Are you doing long calls and puts, which was the example that I opened with, right? Are you doing spread trades, which will make this example, this riskless spread trade, really pointed for you? Okay. Are you doing naked calls? And naked calls are dangerous. Okay. You know what, folks? I had my recording going, and now it shows that it's not recording. So I'm gonna see if I can. There we go. Okay, I've started the recording again. And this last 15 minutes that we spent getting to know each other, that won't be on the recording, but guys, it'll be a good resource for you to come back to and check out. Okay, let me go ahead and close this poll. We've got very good participation. I've had over 70% of the room vote, 71% of the room vote, and I know some of you are calling in, so you can't possibly vote, okay, if you're just calling in. But if you're in front of a computer, please do participate in these polls. Okay, so 19% are not doing options, or you're new to options. Okay. 42% are doing covered calls and naked puts. Not surprisingly, 42% are picking up the other side, right? You're buying those calls that the covered call sellers sold, or you're buying those puts that the naked put sellers sold. Okay, so you're the reason they can do that. 52%, that's the biggest answer here. 52% are doing spread trades. That's marvelous. Okay. And 2% are doing naked calls. Now, naked calls are risky. I would not do them personally. But if you're into it and you can afford unlimited risk to the upside, then they can be a profitable play. All right, but for me, it's too rich for my blood. I'm going to be showing you how to do a spread trade risklessly. Okay, so before I start moving, I'm going to check in with my questions again. All right, and I'm going to ask you. Okay, going to ask you, can you see the screen? It should say, can a spread trade really be performed without risk? And if it says that, then I'm going to move forward. Okay? Yes. Okay, good. We got a whole pile of you. Man, what a responsive group. This is marvelous. Okay, super. Steve says, we'll see. I've got one fella. We got a lot of Steves today, but I got one Steve that's very skeptical. Okay, well, the thing is, yes, it is possible to do a bear call spread without any capital risk. It's all about context. Okay, and now we're going to dive in right this second. Okay, today's class is all about value. It's all about me telling you some really good, useful information that you probably won't get anywhere else. Okay, here's the first play. First play goes like this. You own GILD, Gilead Sciences. You own Gilead stock for $102 cost basis, okay? And then to protect it, now you can't do this today, but you could do this last week, okay? To protect it, you buy August $110 puts for $11.75, okay? All right. In this situation, your upside is unlimited, but if the stock falls, then you can get out and lose less than 5% of your investment, or $375 per 100 shares. In this play, you have the potential to win big if GILD goes up, but you have protection in case she falls. Okay, and so first I'm going to show you the setup just digitally. Okay, and then I'm going to show it to you graphically. So here we are with 100 shares of GILD. Cost basis of $102, and we're buying to open an August $110 put option for $11.75. Now the put option is insurance. What the put option gives me is the right, not the obligation, but the right to sell Gilead Sciences at $110, okay, regardless of where Gilead Sciences is trading between now and August expiration, which is the third Friday in August. Now, here's the deal. The total invested amount here is $113.75 a share, and we're protected we have that guaranteed exit of $110. That's what that put option is. It's a legal and binding contract that means that I can get out at 110. So the difference is all that we have at risk, $3.75 a share or $375 on 100 shares. Got it so far? Okay, now I'm going to go ahead and show that to you graphically. Okay, whoops, I'm going to show that to you graphically, and the way that we'll do that is jump out of here and we'll go over and get a little preview of Power Options. Now, Power Options is the platform that I use to trade with. Apparently 9% of you also do. Just 9. That's not 90 or 19. That's 9%. So for the rest of you, I'm going to give you 2 free weeks. Okay, at the end of class today. All right. So here we are with GILD, 100 shares, $102 cost basis. The August $110 put option costing $11.75 more cents per share, or $1,175 per contract. Okay. Whoops. What have I done here? Submit. Okay, now here's the line that it makes, okay, or the graph that it makes. What we have is it looks like a hockey stick. Down here at the bottom, if the stock crashes, if it goes down, it looks like it has gone down a bit. Okay, if the stock goes down, then the most that we can lose is 3.3% of our investment, or $375 out of this whole $11,000 and change. All right. On the other hand, if the stock goes up, we have unlimited upside. This is called infinite upside potential. All right. That's where we are with that play. All right. Now, having said that, I think that's kind of important. All right. The most that we can lose in this play is, pardon me, is $3.75 per share. Okay. Now, we're going to look at another play, and this is the bear call spread. You might think that GILD is going to go down. And so to capitalize on this with a spread trade, you sell the June 110 calls and then use some of the money to buy the June 115 calls. And again, here's how this looks digitally, okay? And then we'll look at it graphically. The digital effect here is that I'm selling to open the June 110 calls for $1.54 per share, or it's $154 a contract. Okay. Simultaneously, I'm buying to open the June $115 calls for 79 cents. Now, again, you can't do this today, but you could have done this last week. Okay. All right. That's when I put together these slides. All right. So here we are. The total premium that's collected is 75 cents per share, or $75 per spread. Okay. Now, the problem with this second scenario is that normally, all right, you're risking $4.25 or $425 per spread. That's what's happening normally. And what we're going to do is look at the custom spread builder here. And here we are again, same numbers, selling the June 110 calls at $1.54, buying the June 115 calls at 79 cents. So we're generating a credit on the front end of 75 cents a share, or $75 per spread. Now that's marvelous as long as GILD stays down. And the green line right there, that shows the present price. That shows what it's priced at right now. Okay, so right now we're in the clear. We're doing all right. But what if GILD was to go up? If it was to go up, we would have an obligation to deliver shares at 110. All right. We would have the privilege to buy at 115, so we can't lose too much, but we can certainly lose something. What we can lose is $500. Whoops, $500. The difference between the 110 and the 115 price. $5 times 100 shares. $500 is what we can lose, and that $500 is offset by the 75 that we've already taken in. Okay, so really what we have at risk here is $425. There it is, $425 per spread. Okay, all right. Now I just gave the explanation, but I'll recap the explanation one more time, and then I'll look at some questions. Okay, here's why. Pardon me, guys. I got to take a sip of my tea here. Here's the deal. Selling the 110 calls carries with it an obligation to deliver shares at 110, even if those shares are trading higher than 110. Now, normally, you have to go out on the open market and buy it. If the stock stays below 110, that's dandy because you get to keep your 75-cent credit, okay, or $75, and you don't have to pay anything back. But we got a problem. If GILD goes up, you have to deliver shares, and you need to go out on the open market to buy them. Now, good thing is you've got a $115 call option that gives you the right to buy at $115. Even if the stock is at $200 a share, you can buy at $115, so you can deliver at $110. All right? All right, so there's our risk. That's a loss of $5 per share, offset by the 75 cents that we took on in the front end. So that's the explanation of our risk. All right, $4.25 per share, or $425 per contract, or per spread, really. Okay, now I have a question to pose to you. All right, you ready for this? The first play, let's look at it graphically again. Okay, the first play has got a risk of $3.75 per share, or $375. Okay, the second play has a risk of $425. All right. First play has a risk of $375. The second play has a risk of $425. So what's the risk of doing them both? What's the risk of doing this both? Okay. Now, Steve, I'll get to your question. I see that. I see your question. All right. I want to ask you guys, what do you think the risk is of doing them both? And I'm going to go ahead and find which one it is. Okay. There it is. All right, you ready? The poll question is out there. Okay, what's the risk of doing both these plays? One that risks $375 and the other that risks $425. And folks, the reason that I place this in the form of a question, we're not playing Jeopardy here, but what I am doing is using the Socratic method of teaching. Socrates, I'm not comparing myself with Socrates, but I'm going to steal his methods. Socrates used to ask his pupils questions and let them come up with their own ideas. And if they were wrong, he would lead them. And if they were right, he would also lead them. But it was by questioning them. Okay? All right. So I've got 4 out of the 5 categories voted in here so far. I'm going to leave this poll up for about another 3, 2, 1, and close. Now, I know that some of you guys are getting out your calculators. You're saying, wait, I almost have it. Okay, fine. There's a reason why I'm having you think this through. 16% say, hey, the sum of the two at-risk amounts. Okay? If you got one that's risking $375, one that's risking $425, well, it's simple. It's $800. Okay, that's what 16% of you said. Now, 25% said just the higher of the two at-risk amounts. Just the $425. That's all that's really at risk. And then 6% of you said just the lower of the two at-risk amounts, $375. Okay. And then 53% of you said none of the above. Okay. All right. Now, the risk of doing them both, you would think, just off the cuff, if I didn't give you 5 different answers, off the cuff, most people, I think, would say $800. Okay. They just add the two risks. Both plays, one that risks $375 and one that risks $425. Okay? But take a look at the chart. Here's how it's going to actually work out. When we take both of these plays, the married put play, where we're buying the stock and a put option, and the bear call spread play, where we're selling one option and we're buying another, look at what happens. Our maximum risk is $300. The maximum risk is just $300. Now, here's something that's really cool. For those of you that do covered calls, and we got a lot of you, we got, what was it, 42%? 42% of you do covered calls or have done covered calls. You know that when you do a covered call, you put what on the top? A cap, right? You put a stop. I mean, you can't go beyond a certain amount if your stock decides to go up. But in this case, if your stock decides to go up, you have an unlimited upside potential. Okay. Now, this is the stock closing between 110 and 115. What's happening? Well, the thing is that bear call spread isn't really hurting us. What's bringing our profit down is the fact that at this point our put option is decaying. But as this red line will show you, if the stock goes up in the near term, we can make an adjustment and get out very profitably early. Okay. All right. So what this is doing, what we're doing here is we're doing a short-term bear call spread to offset some of the costs of our long-term married put. The married put is got a risk of less than 5%. It's got a risk of less than 5%. And then what we just did was we lowered it even more. By doing that bear call spread, we lowered the risk even more. So you might be saying, what? How did that work out? How is it that I have no risk doing a bear call spread? Well, the risk that's inherent in a bear call spread belongs to not having the stock on hand to deliver, right? But if you already have the stock on hand, the sum of these two is a chart that has less risk than either one. The bear call spread no longer has any risk, and the married put itself has less risk. And here's the really good news. The really good news is that put option protects you for longer than the bear call spread has to be in place. Okay, so kind of nice. Okay, the even better news goes like this. Since your put is out to August and you're selling the June bear call spread, you could do this again, okay, and lower the cost basis of your stock, making it so that you have less potential of a loss. You could do it again, and you could do it again, until finally you've whittled away all of the at-risk amount in this play, and you still have a play with unlimited upside potential. Okay? All right, so real quick, I'm going to ask you, what do you think of that? Okay? What do you think of a riskless call spread? Okay? I'm going to leave that up for a few moments, and I'm going to go ahead and check in with the questions, because I know I got lots of questions. Oh, what happened? Oh, they're there. Okay. Okay, I have one fellow that says, thanks, I have no interest in buying any stock under any circumstances. I'm strictly an options player. Hey, that's okay. But if you were paying attention at the very beginning, I showed you something called force ideal size trades. And what we did was we took a play that would normally be a losing proposition and we turned it into a winner. Believe it or not, owning stock is a vital component of doing exactly what I showed. Okay, it's a vital component of forcing an ideal size trade. So if you don't have any interest, that's fine. If you don't have any interest in buying stock under any circumstances, I get it. Okay, but some folks are going to do a lot better. In fact, you know what? I'm going to go ahead and put up another poll here in just a second. I'd like to see how what you're doing is working out for you. Okay. All right. Let me go ahead and close what's up there right now. The poll that's up there said 19% said that was wild. I didn't know you could do a riskless spread. And then 17% said this one trade made it worth all the time I spent here today. Hey, great. We're only 34 minutes in, and you've already gotten your money's worth. Good deal. Okay. 58% say I want to know more about riskless spreads like this. Good, because guess what? There are 12 different ways to take income out of a married put play like I showed just now. 12 different ways, not just the one, not just the bear call spread. We call that one income method number 6. Okay. Let's see, 22%, can I do what you just showed in an IRA or similar account? So yes, the IRA account, you can do that in. There's something that they do in Canada, SRSS or something like that. It's available. All right. 31% say I especially like reducing the risk. Is it really possible to go to zero? Yes. In fact, it's not just possible. It's rather commonplace. Okay. All right. Let me go ahead and ask this poll here. I've already asked this one. Okay. What kinds of trading are you doing right now? All right, and so we got this readout from before, and we had 71% of you answer the poll, so very, very good. Thank you very much. Now, what I'm going to ask you is just a follow-on to that. How you doing? How you doing? How has that worked out for you for the last 12 months? Okay, instead of, well, I won money or I lost money, I've got a spectrum of answers here. Fan-friggin-tastic, okay, or I'm doing okay. or about flat, or I'm losing, or I'm ready to quit. Okay, so show me where you're ending up in the spectrum. I've got a lot of folks have voted, but I've only got 3 categories that have been input here. Okay, now we've got 4 categories. Wow, you know what? Nobody has told me that they're ready to quit. That's really encouraging. That's really encouraging. Okay, now that previous poll, we had 71% of the room answer. So I'm holding out. I'd like to have at least 71% of the room answer this one. Okay, just want to know how this is working out for you, that trading that you've been doing. Okay, we've got about 7 seconds left in the poll. And 3, 2, 1, and close. All right, now, so a very small minority, 6%, are doing fan-friggin-tastic. Okay, making money hand over fist. Good for you. I'm very excited for you. I think that after I show you some things, you'll do even better. 21% say doing well, a better year than most, for sure. Good. Okay, that's happy. Now, 38% are about flat. Okay, so you need to find a tweak for your game to pull ahead. Okay, and then 35% said, yikes, I'm losing money and I want to stop doing that. Okay, folks, this is very, very close to the classic 20-80 split. Today, it's a 27-73 split. Am I doing the math right there? Yeah, 27% are doing well. The other 73% are either flat or losing. Okay, so would you like to have a game changer? Well, I'd like for you to think about what I just showed you. Okay, what I just showed you. Remember, it was these three promises. The first promise was I was going to show you how to keep your risk in any one stock down to 5% or less. Number 2, I was going to show you a riskless spread trade, and I did. It was the bear call spread. Done in the correct context, it's riskless. And then number 3, I was going to show you bulletproof. Bulletproofing is reducing the cost basis of your stock little by little to offset the cost of insuring it. Okay, so I've shown you all 3 of those. All right, I've done the 3 promises. Okay, and it's not just possible to bulletproof your stock, but it's commonplace. By using the income methods to whittle away the cost basis of your insurance, we do this all the dang time. Okay, so now knowing that, think about what I just showed you. If you limited your risk last year, perhaps you're a covered call player. Okay, let's say you're buying stock and selling calls against. Sometimes you get called out, sometimes you don't. All right, sometimes your stock goes down. All right, if we had somehow the ability to go back and erase whatever losses you took last year and replace that loss with 5% or less, would you do that? Think about what I just showed you. If you could keep your loss down to 5% or less in any play, would it have been a better year? Okay? All right. Now, I've got a whole bunch of you, and I know you're getting tired of polls, but the thing is, we're interacting here. We're making this a conversation. I'm going to get to some more questions here in just a minute. Okay? Let me give you another 5 seconds. We've got a lot of you voting. Thank you so much for your participation. And 3, 2, 1, close. Okay. And share. All right. Now, a minority did say, 23% did say, no, limiting my risk to 5% wouldn't have helped my trading. So I'm thinking that you probably have already limited your risk to 5% by another means. Okay. 15% say, yes, I may have lost last year, but I would not have lost as much. And then 15% more said, yes, and I'd be ahead by as much as $500. Okay, as much as $500 better than you did last year if you had just simply practiced this loss management. 31% says, yes, I would have done between 500 and almost 5,000 better. And 15% of you said my savings or winnings would be $5,000 better than what they were. So that's pretty convincing. That tells me that there's quite a bit possible here And maybe you should consider what you'll answer that same question next year. If I ask you the same question next year, hey, should you have kept your risk down to 5%? Would you say, yeah, I should have, or would you say, you know what, I did, and tell me how that worked out. You see, the best part about this radioactive profit machine idea, this buying a married put play and then using one of as many as 12 different income methods to offset the costs. The best part about it is that while you're doing riskless spread trades to capture your income, you're also sitting on a stock that could potentially go way, way up. Now, my friend Mike Chepka, who I thought was going to join me today, but he has had the opportunity to be sitting on a riskless stock and get to the place where he bailed out when it was 58.9% gain. Okay, sucker, he beat me. Okay, but I'm going to tell you about one of the plays that I did. Okay, Marvel stock I was playing, and Marvel got bought out by Disney. Okay, now here's how this went down. I was sitting on a bulletproof stock, and then Disney comes out with the intent to buy Marvel for $4.4 billion per share. So while I'm in a position where I can't lose anything, bulletproof, kind of like Tony Stark here, I've got a suit on of armor, I'm bulletproof. Well, what happens is my stock, which can't go against me, there's no break-even line there, shot up over 30%. Now, I'm not saying that to brag. I'm just letting you know that that's the sort of thing that's available. By the way, if I had done a covered call trade, if that's the way that I was hedging my stock, would I have been able to get out with a 30% gain? Probably not. Probably more like the 3 to 5% that they promise you, right? Okay, so sitting on a stock that was completely bulletproof, no possibility of losing, then a surprise announcement comes out and, hey, we're buying Marvel. Disney is acquiring Marvel, and 30.2% gain in a 2-month period. So guys, what do you think about that? How about that? Would you like to learn more income methods? I already had a couple of you mention it. Now, what I'm going to do is take a few questions right now. Let me just open up the question pod here so I can see what's going on. Okay. Okay, Steve says, suppose that your purchase stock continues down in free fall. Okay, well, at the very beginning, promise one was, hey, we're going to show you how to keep your losses down to 5% or less. So if your stock goes down in free fall, would it be better for you to have this put option in place or not? Would it be better for you to have it, or just cross your fingers, or use a stop loss order, or use the pray and hold and hope method? Okay, so what if? That's a good question. What if your stock continues down in free fall? Well, in the example that I just showed, you'll lose 2.7% of your capital because you only had 3.3 at risk to begin with, and you offset some of that with your income method. Okay, good question. Okay. Okay, Tony says click the wrong box. I guess that was probably on one of our polls. Venkatesh says, after the expiration of the August put in the GILD example, don't we have risk again with the stock going down? Yes, and that's why we want to exit before that expiration. That's a really good question. Let me go ahead and show it to you graphically why we would want to exit sooner. Okay, now here we are with the with the married put play. Okay, the married put play has got both the stock and the put. Now, at a certain point, we're going to have this compound looking deal, but then after the bear call spread expires, we'll be back to this, only with a little bit less cost basis. Okay, we've offset it by collecting 75 cents. Well, let's just, for simplicity's sake, let's take it off of there. There's your 75 cents. It just went away. 75 cents off of the net cost. And so now you'll be back to this position, Venkatesh, where it's a hockey stick graph again, but instead of what was it, 375 that you could lose, now it's only 300 that you could lose. Okay? Okay, and the question is, after the expiration of the August put, don't you have risk again? Yes, that's why we don't wait until August. The blue line here represents August expiration. Now, here's the deal. If the stock is doing poorly, which in this case it is, right? If the stock is doing poorly, getting out early, you lose less. And if the stock is doing well, getting out early, you win more. All right, so we don't have the intent when we buy an August put of holding it all the way till August. We have the intent of getting out probably way before then. The red line in this case is July 1st, so July 1st is a good target. Okay, good question there, Venkatesh. All right, others. I've got other questions. Oh, I arrived late. Can you briefly explain what a married put is? A married put is when you buy stock, but then you also buy insurance, an insurance policy that keeps you from losing too much if your stock goes down. Okay? All right. Now, folks, there's a reason why I chose this, and the reason is this. The reason that I chose this particular stock, I just grabbed this last Thursday when I put together these slides. I just grabbed the prices of the put option and so forth. And here's the deal. I've got a radioactive trading client that's in 300 shares of Gilead Sciences, and it is the 110 put, the August 110 put. Now he spent more than $11 for it. What he spent was $13.21. Okay, and his cost basis on the stock now, because of doing income methods, his cost basis on the stock now is been whittled away down to $92.68. Okay, now let's take a look at what his position is. This is David K. from Australia. He is what we call bulletproof. This bottom line here, if the stock decides to crash, all right, and the blue line there is where we exit. The bottom line is a maximum a profit, a minimum profit of $1,233. Okay, he has negative risk of 3.9% negative risk. All right. Now, within the context of this, he could still do these plays. He could still do maybe one of these bear call spreads. How about it? We could have him sell one and then buy one. Sell the 110s. Okay, that's not the best example. Let me take a look here at the prices. Buy the 115s at 24 cents. Okay. And so what's happening right there is generating another $120. Okay, what that is 64 in, 24 out, so that's 40 cents, but it's times 3, so $120 in. Okay, makes his profit even greater. All right, and if the stock closes below 110, which it looks like it's going to, right, he's going to do even better. Okay, so the point is, while he's sitting on stock and also has a put option, he's able to use one or more of 12 different income methods to continually lower and lower and lower his cost basis. So the question is this: would you like to learn more income methods? Let me go ahead and pose that as a question here, folks. Would you like to learn more income methods? Okay, I'm getting plenty of yeses. Why? Yes, why? All right, very good. Well, one thing that you could do is you could keep coming to these free webinars, okay? Because they don't always do the exact same deal, all right? That is one thing that you could do. Wendy says yes with 3 exclamation points. Thank you, honey. All right. If the put is, let's see what Jill said. Hang on, I've got to make it bigger. If the put is approaching expiration and you want to keep the stock, do you roll the put out? Good question, Jill. There are actually several different things that you can do if you decide you want to keep the stock, and what you've described is one of them. Okay, we call it income method 4. we're actually able to guarantee a higher payout when we do that. Kind of cool. All right, so that's a good question from Jill. Keiko, Marcia, Steve, and Wendy all say yes. You want to learn more income methods. Oh, we got some. Yippee, says Jill. All right. Now, here's the deal. What you could do is you could just keep coming to these free webinars, okay? Because I don't, I've got to switch things up a little bit. I can't just do the same thing day in and day out, okay? So I do put some variety into these. I use different examples. I use different stocks. I use different income methods. Now, back when I was only teaching 9 income methods, we had this situation happen. This is a true story. We had a medical doctor on the East Coast contact us and say, hey, thanks for the information that you shared at the free webinar. I just made over $900 profit on V, which is a Visa card or Visa card services, after I bulletproofed it using income method number 4. Okay, so this guy did really well. He made $900 profit on Visa. And everything was awesome until I got to this part. Here's what he said. I've been coming to your webinar since October of last year, and it was November. So guess what? 13 months of webinars. 13 months. He said, you've only showed income methods number 1, number 3, number 4, number 9. When will you be doing number 2 and 5 through 8? And this was my face. Dude, seriously? Seriously. We actually looked up Dr. Smith's attendance record. It's not Dr. Smith, okay? But it was Dr. S, okay? I'll give you the last initial. We looked at his attendance record. He'd been to 86 webinars, most of them more than an hour in length. And then, using our techniques, using the stuff that we shared for free in the webinars, he made $900 after bulletproofing his Visa stock, just using one of the income methods and being bulletproof, and then turning around making $900. So pretty cool. But I wonder how much he lost out by not knowing the other income methods, just because he was trying to get them free instead of ponying up the tiny fee for the blueprint. Okay, so kind of ridiculous, I know. That's about 90 hours worth of webinars to try and get all the income methods free. And I don't know what medical doctors earn, but it's probably more than what he was trying to save. Okay, all right, so here's the deal. Anyhow, here's time to discuss the price of the blueprint for you. And perhaps more importantly, the cost of not owning it. And Clive, I see your question. I've got to expand it so I see that you asked a question. I'll expand it here in just a minute and answer it. Now, this is a prepared slide right here. I've prepared this slide ahead of time, but I'm willing to bet that some of you said that the blueprints technique would have made a difference in your portfolio of over $500. So let's go back and open that poll again. I'm not going to run the poll. I'm just going to show the results. Okay. The result was, okay, we had 15% of you say, yes, I'd be ahead by as much as $500. Another 31% said, yes, I would have done between $500 and $4,999 better. And another 15% said my savings / winnings would be $5,000 better than they were. All right, so that's, what is that, 61% of you told me that it would have made a difference to your portfolio of over $500. Okay, more than half the room, 61%. Okay, so some of you said over 5,000. Plus, do you think that you might trade for more than another year? Do you think you might be trading for another 10 years or so? Okay, or 20? Well, let's consider that. There's one fellow that raised his hand during one of my live seminars. Instead of doing this polling function, we would raise our hands, and I would say, okay, how much would you have made? How much would you have saved? How much? And I'm going around the room, and one fellow still had his hand up after $30,000. And I said, sir, would you have saved $30,000 last year on a bad trade? And he says, in your account. And he says, no, I would have saved it in one trade, in just one bad trade. If you had just shown me how to do this stuff a year ago, it would have made $30,000 difference in one trade. Okay, so what's the cost of not owning the blueprint? If it's $5,000, right? If you're one of those 31% that said, hey, $5,000 over a 10-year period, that might be 50 grand. The guy in Colorado Springs, 30,000. He would have saved 30,000 in one trade if he'd have known how to do this setup. Were you one of those folks that said $500? Okay, and do you intend to trade for 10 years or more? So maybe just $5,000. But this is the cost of not owning the blueprint. And so, what does the blueprint really cost? Well, I'm going to say that I would feel comfortable and I would sleep very well at night charging $5,000 for it. We have had a number of people write to us saying that they got more than 10 times the value out of it at 1/10 the cost. Some folks that have gone to these weekend seminars where it's $3,500 to attend, or these cruises that it's $6,000 to go on the cruise, and then during that cruise they teach you how to do credit spreads. Folks have come out of those, and then they've also come to my classes, and they've gotten more value out of the blueprint than out of just that $6,000 investment. Okay, so I'm not going to charge $5,000 for the blueprint. If it was half that much, it'd be worth it. Okay, it'd definitely be worth it. To many of you, it would be worth 10 times as much. Okay, but if I was to cut that in half, it'd be $1,250, right? I've got news for you. I am not selling the blueprint for $1,250. In fact, the price of the home study kit, which is our premier product, is $599, and that includes the setup of the radioactive profit machine, all 12 income methods, how to combine the income methods, and which income methods to not combine, how to manage the income methods. For example, income method number 5 has 5 different ways to manage it. It's a very curious spread trade that pays you on the front end when you enter it, and then it pays you again when you exit it, one of 5 different ways. Okay, well, $599 for the home study kit is a steal. It's a bargain, but we've got even something better available. Okay, here's the best offer that we have going, and the best price at which the blueprint will ever be available. If you'll go to radioactivetrading.com/iridium, you'll see the bonuses. Okay, now I'm going to go ahead and click back into radioactivetrading.com, scroll up to the top, and find products. This is what most folks see. Okay, they see the blueprint itself listed at $339. The home study kit I just mentioned at $599. The home study kit basically is the blueprint plus audio-visual materials that make it really easy to cut down the learning curve. Okay, so if you learn that way, if you're an audio-visual kind of a person, this is your best bet. And if you're the kind of fella or lady that learns very well just by reading, then the blueprint is a better value. Okay? But I haven't shown you the best thing to do. The best thing to do is to go to Iridium. radioactivetrading.com/iridium, IRIDIUM, the chemical element, and then we have a number of free bonuses we're giving away along with those prices. So this is good to the end of today. I highly recommend that you go and pick it up. Now, if I was to talk about a bulletproof position, okay, wouldn't it make sense for me to give you a bulletproof offer? Well, that's kind of the way that this is structured. You see, if you don't make as much or more, than the blueprint costs you, then I want you to send it back. Okay, I want you to send it back. It has a money-back guarantee, so you risk nothing. You know what? Just paper trade. Just paper trade. That's what we tell you to do in the first 3 chapters. Tell you, look, try this out for 60, 90 days. See if you can break it. See if you can break this machine, this radioactive profit machine. And if you find out that it would not have saved or made you more than it costs, I want you to send it back. Okay, that's our 100% money back guarantee. Okay, so I'll take a few more questions. Although we're at the end of today's show and class, it's the top of the hour. I do want to give you this as well. Okay, earlier I did a poll where I found out that only 9% of you are using Power Options as your platform for finding and tracking and managing your options trades, and it is the best platform available. I'll just say that. And if you go to powerop.com/RAT, No credit card required. Nothing but your name and your email address, which we already have. All right. All you're going to do is plug in your name and email address, and they'll give you 2 free weeks. Okay. All right. Cool. Well, let me go ahead and open this up and see what kinds of questions we're having. Okay. Da-da-da. All right. Questions. Piles of good ones. Okay. Do you have to buy stocks with the blueprint model? Asks Wendy. Yes, Wendy. And oh, it looks like Mike is chiming in. Mike is actually in the background doing the questions in print. Thank you, Mike. I appreciate that. Okay. So yes, you do. In order to get the proper position sizing that we talk about, you're going to want to do the stock plus put method. Okay. All right. Mushroom, that's an interesting first name. Mushroom says, does the blueprint include strategies that we can use to take advantage of the blueprint, or is it just book smarts? The blueprint is chock full of strategies that it's all practical examples. It's not, none of it is just a theoretical exercise. Every single example in the book is a trade that I have done or one of my students has done. Okay, we use the actual trade numbers. What was the internet address for the various programs, says Steve. I'll go back a slide. Whoops. Go back a slide. It's radioactivetrading.com/Iridium. IRIDIUM. The thing that I've got up there on the screen is not a clickable link, but Mike, can you send everybody a clickable link through the chat line? Oh, good. Mike has already done that. Good. How far out is too far or not far enough to buy the protective put? Asks Daniel. Daniel, that's a good question, and it's going to depend on your stock's individual volatility signature. For example, GE does not trade the same way as Netflix. Okay, and so depending on the stock that you've got, and depending on how volatile it is, and what your risk tolerance is, you'll want a put that's closer in or further out. A good guideline is to buy a put option that's about 5 months out. That's a really good guideline. And as far as how much in the money, 1 or 2 strikes in the money. Martin says, can you do synthetic stock with options instead of buying stock? I don't know what everybody's problem is with stock today. I'll tell you this, that doing the actual stock is what puts in place that first principle of forcing ideal sized trades. Do you remember at the very beginning where I showed, hey, 66% wins and 40% losses, and how you never get ahead? You never get ahead with the 66% wins. You know what? Let me go ahead and actually pull that up. Let me just actually pull that up. Can I go back? I'm going somewhere with this, okay? There's our trade simulator. Okay. Yeah, somebody texted in, I still don't really understand options, and that's okay because my book is written for folks that are starting from that place. Now, take a look here. We have our target return of 66%, our loss limit of 40%, and this is what they call a leveraged play, okay? As long as it's leveraged, you're going to lose, okay? You're going to lose. And what leverage means is, hey, you're using just strictly the call options, for example, and using all of your account. But what if you're to take all of your account and instead of buying a call option, turn it upside down to where you're spending 95% on stock and 5% on your put, so you're only risking 5%. Okay, now we've got a winner, don't we? Okay. I can't stress this enough. Forcing an ideal size trade, you can even lose more often than win. This is a $100,000 stake here, right? The low of this play here is 6.6% loss. That's the low after 3 losses consecutively, right? But then the ending amount here is a 57% gain. And that is certainly possible, okay? We don't guarantee things. I don't do this nonsense like say, hey, you're going to make 3 to 6% per month every month. That's nonsense. And yet there's covered call trade gurus out there all the time promising those kinds of returns. You know what I can promise you? I can promise you you won't risk more than 5% of your account. That's what I can promise you. And then as you're doing that, getting on top of the losses, even if you lose more often than you win, you can still end up making money. Okay? Great questions there, folks. I sure appreciate it. I'm going to put that slide up there one more time and get back to the questions one last time. Are there two different options on the special, $300 or $599? Clive, the special is it's $599 for the home study kit. It's $339 for the blueprint. Good question. It looks like Michael has been answering a lot of questions. I'm just going to pick up the ones that I think everybody needs to hear. How to get the audio visual at the cheapest price. The cheapest price is $599, and it is a guaranteed purchase. You will get $599 worth of value out of it, or I will buy it back. Cool. Okay. Folks, that is radioactive trading, and you're welcome. We've just seen a lot of things coming in already. How about that? I didn't actually say we're done, but we're done. Folks, I'm going to recommend that you go over right now to radioactivetrading.com/iridium and take advantage of the offer before those bonuses go away. Do you need to have power options to take advantage of the training program? Asked Steve. No, you don't. Love it, says Jill. I was just buying stocks with no protection. Yeah, just imagine, Jill, if last year you didn't take any losses of greater than 5%, but you still had the upside potential of owning the stocks. Pretty cool. All right, you're welcome. You're welcome. We got a couple of thank yous. All right, folks, I'm going to go ahead and close it up for now. If you think of a question that we didn't handle and you think of the question afterwards, go ahead and write us at support@radioactivetrading.com. All right. Okay, you know what? Final two questions here. Clive said, do you need to spend a monthly fee after buying the home study course to use the Power Options? Okay, Power Options itself is a subscription service, and it's separate from, but does support radioactive trading. Okay, you would need to do that no matter what you do. I mean, you would need to do that with any kind of options trading. Okay, and Steve wants me to give him a phone call. Okay, I'll do that. I'll give you a call. Who else wants me to call him? If you got a question that's that's brief, okay, and to the point, I'll give you a call. Okay, all right, Steve, I got your number. I'll make sure that you're first. You're welcome. All right, super. Okay, guys, we're gonna finish up, and we'll see you out there. Happy trading, and bye for now.